Welcome everyone to the Real Estate Experience. Super excited as always to have you on. You know the next steps. Hit that subscribe button on the YouTube and that notification bell so you can be informed of these absolute bombs and golden nuggets that are dropped, where we have other high achieving investors that are in the industry really provide their experience shares of what has gotten them to where they are now. And today we have Charles Dobens on. Welcome to the show, Charles.
All right. How you doing, Sterling? Hot dog. Oh, this is gonna be fun. Man, all right. I can't wait to hear these nuggets.
Really, well, I'm ready for the nuggets on your side.
And listen, I haven't even made them up yet. So like, I'm ready. They're just going to drop. They're going to drop like other types of nuggets in a moment, I'm sure. So yeah.
Okay, perfect. Right. So Charles Dobens is with Multifamily Investing Academy, which is what he started. And he's been involved in well over $1 billion worth of transactions. And that is with a B. Oh, 3 billion. 3 billion. Yeah. Okay. All right. And has purchased more than 800 units. And a fun fact that I asked him right before this, that many of you, I'm sure you've got a glimpse of it, is he is good looking. So that's
incredibly good looking.
Incredibly, yes.
Wrong, Sterling. I gave you one line and you blew it, brother. Gosh, you know, and this is why I have to tell everybody this, because they always get it wrong.
All right, so and tall. Okay, so if you could give everyone, what's your 5% ultimately that has shaped you to who you are today and how you were able to get into real estate ultimately?
Oh man, I tell you, there was so many people that have shaped me, and it's taken years of development to get to where I am now. I was not born this way, and it
incredibly good looking.
Yeah, I know.
Were you born that way?
I didn't start until like last year. Okay, you know, when I got the beard, and that's when I got cool, as my kids would tell you. But you know, it's taken years of development there, and I can tell you, and I said this on another podcast. Somebody asked me like, "What does a law degree do for you?" It just gives me confidence. It just gives me confidence. And if anything has developed over time, it's been my confidence in the ability that like, hey, why not me? I mean, right now I'm actually going out tomorrow to make an offer on 2 parcels of land to start developing apartments. You know what, Sterling? I've never developed before. Everything I've done has been own and operating existing properties. I've never developed before. In my neck of the woods, the demand for units is so strong, they just don't exist. We have to build them. So it's
what market are you in, Charles? Or the market?
Right, and this is where I'm at now, southern New Hampshire. So it's right on the New Hampshire, Massachusetts border, which is another beautiful thing because Massachusetts is they tax you, they call it Taxachusetts, and New Hampshire is free. So people move to New Hampshire. So New Hampshire is doing incredibly well. But the way I look at it is like, hey, we need more housing. We need to develop more housing. Well, who's going to do it? Me. Why not? If I know all the developers in town, they're great guys, but they got nothing on me. I can do what they do. So I'm just going to go out there and start developing. I'm going to make mistakes just like I did in the multifamily side when I bought my own properties. But you know what? I'll figure it out, and I'm going to become the king of workforce housing in New Hampshire. That's my objective. So before I die, they will bestow that crown on me somehow.
Love it. And so how do you go from being what you currently are, attorney, or from law school to real estate? How does that work?
Well, actually, it was more like I was going to law school nights, working in the insurance business. Swore I would never do the insurance business, but when I got out of law school, I was making so much money. I thought, I can't really give up the insurance business. I got young family and everything, so I kept doing that. I actually went out and started my own insurance company. It was a benefits administration company, and did that for 10 years. And Sterling, it was a miserable existence. It just was. Oh man, I hated getting up and going to work every day. And so finally I said, I can't do this anymore. I've got to quit. And so we sold that business, and my wife said, what do you want to do? I said, I've always wanted to own apartments ever since I was a young boy. All my heroes were real estate owners.
Was there any high, like a Robert Kiyosaki or something, or just local people you knew?
Guys. There was Sam Tamposi. He was, Jerry Nash. I mean, I'm friends with Jerry Nash's son, Peter. He's my landlord here in this office building that I'm in, and he's selling me some land. And so, I mean, these were just regular folks. This is why when people talk about, well, you know, you got to find an emerging market. You know, how about in your own backyard? Because all of the people that were my heroes in real estate, they did it right here in Nashua, New Hampshire. They made so much money that they ended up owning, you know, part of the Red Sox. They just had, you know, they could do it. And so, you know, this is how it happens. You just have to focus on a particular marketplace and become an expert. So it didn't, you know, I didn't have to travel far afield. When I bought my apartments all over the country. But, you know, I decided when I sold them down to 2 complexes that we're selling next year, and I'm building now. I moved back here to New Hampshire, and I'm going to start building right here because that's where, I mean, it has always been a phenomenal market, and now it's an even better market. I mean, just to give you an example, the golf course that I learned how to play golf on, a 36-hole public course, like right down the street from my house, where I grew up, they just sold. This is their last year. This is it. You know, never be able to play that course again. And they sold out to Amazon. They're putting in a distribution center. Yeah, 5,000 new jobs, and they don't have a place to live. So, yeah.
There's a demand. Awesome.
Absolutely. The demand for our product right now is unbelievable.
And so, Charles, when you made that transition, you mentioned you had the thought process of why not me, or did you have any limiting beliefs so when you made that transition, did you go straight to multifamily? Did you start with single family, then transition to multifamily? How did that go?
No. It's a great question. I started off with multifamily. My wife and I kind of dabbled in single family, like looking for fix and flips. Scared the daylights out of me. I
putting all this money into it, and at the end of it, it's going to sell for this. Exactly.
Yeah. And the thing is, in the town that I live in, the area I live in, like you can't buy land for less than $400,000. So if you screw up, you screwed up big. Okay.
Got it.
So I just saw that as being risky. Now, coming from, you know, owning my own company, I could read a financial statement, and with a multifamily business, it's just numbers. It's just a financial statement. You're buying a business is what you're doing. And that was easy to me. I could understand that. And that's what I teach in my Multifamily Investing Academy is how to understand the numbers better than your accountant. And, you know, that's how I do it. But I was a lawyer when I owned my insurance company. Then, you know, when I got out, I started buying property and the market crashed. And then, you know, so I started practicing law. But, you know, so my most favorite clients were other real estate investors who were getting the crap kicked out of them because of the market. And so they contacted me to help. And I came to the realization, man, some of these people should never have done the deals that they did, even in a good market, because they were just bad deals. And I thought to myself, I need to teach people how to do it the right way.
And I want to dig into that, Charles. And
I know you do.
Yes.
You start making notes on the side, like, oh boy, I pushed some button there, didn't I?
Yeah, because I'm a firm believer, and this is one thing I just recently learned is they say, yes, it's good to learn from your own mistakes, but a step above and beyond that is it's even better to learn from others' mistakes. During that time, which one I see is people over leveraging in that time, putting too much debt on it. What were other things that you saw from those operators that got them in trouble?
Yeah, I mean, those are great points. And that's what I tell people. I said, sign up with me, work with me, let me be your coach mentor so that you don't have to make any mistakes because I've made them all for you already.
There you go.
Let's shorten your learning curve very quickly. Boy, over leverage is a key one. But keep in mind, back in 2008, there was what we call stupid underwriting going on. And, you know, the banks were complicit in how bad things were, absolutely complicit. So some of those things, for instance, if you could fog a mirror, you could get a multifamily mortgage. But then if you start digging down deep, I mean, a lot of people came into this business back then with rose-colored glasses. And I see one guru doing it now, where he's actually, I got a picture of his podcast where he says, you can overpay for multifamily property because the prices never go down. And I'm like, this guy must be 12 years old because he obviously wasn't around during the last crash, because I can show him some of my property that never came back in value. So that's bogus information. But some of the things that people do is they just don't know how to evaluate the deals correctly. They will look the other way at things that other people who have been in the business know are red flags. And, understanding income, let me give you one very simple example. So everybody, we buy cash flow in this business, and the cash flow that we buy is called NOI, net operating income. And that net operating income is made up of two components, income and expenses. Now, there are two types of income, and there's good income and there's bad income. And you might be thinking to yourself, Charlie, what's bad income? If it's coming in my pocket, it's got to be good. Well, yeah, maybe if you own the property, but if you're valuing the property, there's some income that just you should not include in that valuation. For instance, late fees. Okay, yeah, late fees do come in and they happen a lot, but if the guy's got a huge number on his late fee category, that's not a good thing. That doesn't speak well of the business. And my definition.
So you would normalize that. You would say in a way.
I would kick out some of these bad income components. So for instance, late fee. Here's my rule for bad income. If the tenant performs under the terms of the contract the next month, and that income disappears because he's performing, that's bad income. Bounced check fees. Well, if he didn't bounce any checks next month, am I going to include that income in there? No. So that's bad income. So that's how I describe this, and what I teach all my students as well. But the other here's a one that I absolutely love. Now I love it because I know what the seller's trying to do. Back then I got screwed for it. If you see a line item for income called admin income, okay, all right, what does that mean? Like, don't just gloss over like, oh, they're getting a fee for administration. No. What are they getting that fee for? What are they really getting that money for? And typically, and I see this happen down in Texas a lot. I don't know why. I see this happen in Texas a lot. What they do is they don't have any security deposits. And you can see this right. That's
the rent roll.
Exactly. So if you see a property on looking at the rent roll and there's no security deposits listed, red flag. Okay. And then you see an admin fee, double red flag. And here's why. What happens is they'll bring in a tenant and say, hey, we don't have any security deposits here, but we have a $200 admin fee. Okay. So when I leave, do I get that money back? Oh, no, that's an admin fee. You don't get it back. And what ends up happening is you, the buyer, see all this income under admin. It's a one-time income. You're never going to get it again. So when you buy the property, you're not going to see that money. Not only that, and then you capitalize it because you're including it in the income category. Mm-hmm. So that's the first time you get screwed. The second time you get screwed is when that tenant moves out and they trash the place.
You're not able to get the security. Yeah, gotcha. Yeah. Even though it's $200, but still.
Exactly. But like in Texas, you're not going to get anything more than that. It's not like up here in Boston where you get first, last, and security deposit. Try pulling that thing down there. This property in Fort Worth, Texas. Everybody will move out the next day. So yeah.
Awesome. And so in essence is that very first deal, what was it? How many units?
Well, for me, it was 40 units. Was the first one I did. Yeah. And it was a beautiful property. I loved it. We sold it. And, so it was 40 units and we had about 9 investors in it with us, friends and family. And, I tell you, we built our business the right way, right from the very beginning, where we cultivated our investors and we kept them abreast of everything that we're doing. And, every time we made an offer, we let them know. Every time the offer caved, we let them know. And so finally, when we got a deal under contract, they were ready to go. They knew we had done our homework, that we were, really properly evaluating deals. And so we got this deal. It was a beautiful property and everything was going swimmingly. And the bank comes along and says, hey, that 88 units across the street from you? And we said, yeah. He said, how'd you like to buy that one too? And we're like, well, how much you asking? They said $750,000. No, I'm sorry. What am I talking about? It was like,
Well, I was like, what? Is that the rehab?
no. Yeah, I
Or
was gonna say, well, that was a down payment. That was a down
okay,
payment.
the down payment.
It was more like 4 million. It was more like 4 million. And so, so we went and,
I was thinking, are these sheds? I'm just kidding.
no. Yeah, no,
I
yeah, no
got you.
kidding. No, I got that wrong. So what happened was the bank said, do you want to buy them? I said, well, we're kind of all out of friends and family who have any money because we just tapped them all. And I don't know where we're going to raise $750,000. And they said, well, what if we lent you the down payment?
Wow.
Wait a minute.
And when was this, Charles, during this time?
2006.
Okay, gotcha.
Before the crash. And so I'm on the phone with my wife. I'm like, I got the phone there. I'm like, hold on 1 second. Hey, honey, they want to lend us the down payment to buy the 88 units across the street. What should I tell them? She said, ask them how quickly we can close. And I was like, yeah, how quickly can we close? 2 weeks. We're doing it. So within the first 6 months of me being in this business, I owned 128 units like that. Not to say that's, the way it works for everybody, but that was my path through the journey. But let me tell you something, Sterling, because you touched upon something at the beginning of this conversation that is very important as a business owner. And that's what you are as a multifamily investor. You're a business owner. Leverage is the killer. Okay. Leverage can kill your business. Over leveraging can kill your business. That first deal, the 40 units, I put 30% down.
Okay. Awesome.
Never had to worry about that property. I slept like a baby when I owned that property. The second deal, the 88 units, the double in size, I didn't put a dime down. 100% leverage. I never made any money on that property. Never.
And that's what I was just going to ask too, which is what we had touched on. So in that scenario, how did it? So you had there was just not enough income to really service that debt when rent started to pull back a little bit?
Yeah. That property net was break even all the time. We never had to really put money into it, but we never took money out of it. It was, and then the markets crashed and the cap rates went up, and it was a disaster. It's one of those things. Like I said, learn from me. Don't make the same mistakes I made. When I see a student bring me a deal that's seller finance, I got one going on right now with one of my students, and this kid's a bright kid, and he's been with me several years, and he's done incredibly well. This kid's already a millionaire, young, probably in his mid to late 30s. I call him a kid.
That's what I'm definitely a kid. I'm in my late 20s.
I know. I'm like, I'm 82. I'm 82. So, but
no
anyway,
way, you're not 82, Charles. There's no.
First off, Sterling, the fact that you have to question that is a little insulting to me.
Younger.
Yeah, this is the only way I get compliments. Okay, I have to tell you when to compliment me. Okay, so the student he's done everything right. He is smart. He is savvy. He doesn't take crap from anybody. He knows the numbers. He knows when to go up, when to go down. And he's involved in this deal. And the seller's giving him onerous terms, but it's all self-financing. And he's like, well, I only have to come up with $20,000 to do this. So, but I said, you never want to enter into a contract that you can't perform under, when you're doing it. And this thing could go wrong and can go south so quickly. Just don't do it. And finally, I just had to rein him back. I said, listen, you're a bright guy. There's so much emotion in your voice regarding this deal. You're not thinking squarely on it. You just take a step back. I don't want you doing this deal. And so I'll let you know how it turns out, because I think he's still negotiating with the seller, but I'm telling him, I said, listen, this is not you. This is not how you got to where you are.
My question to you is, how do you, from your point of view, avoid getting, let's say, falling in love with the property? Because I've done it times, and it's really one of those things that puts your blinders on. Do you have someone else come in from an outside perspective, or you just have the self-awareness now to say, all right, looking at the numbers, this just doesn't make sense?
Yeah, I'll tell you something. I don't. These are just. This is just cash flow for me. The properties are the properties. It's all about the numbers. That's what. If the numbers work, you buy it. If the numbers don't work, you fix it. And if you can't fix it, you move on. That's it. That's it. And you are in the driver's seat when you're in that position. So I'm not looking for a deal. I'm looking for a great deal. You listen to Dave Ramsey. He's the same way. He'll buy multifamily, but it's got to be a good deal. And
does he still use debt? Because I know he's not a fan of debt.
Oh yeah. Well, I don't know how he would. Well, the thing, yeah, I know that's true, but I've heard him talk about multifamily that way. Whether how he finances, I don't really know. But it's true. Is like you've got to make sure that it's a great deal, or you just don't do it. Why bother? Why should you take on someone else's problem? And sometimes that's why these sellers are. Well, actually, that's always why sellers are selling. Every seller has a problem. It's your job is to figure out what that problem is and identify it and solve it. And I'm telling you, even if the person doesn't seem like they got a problem, they got a problem. They own this property that they don't want. Mm-hmm. That's why they're selling it. So you got to figure out, and what the motivation is for the seller as well.
And for you is what types of questions, because of course, many sellers, they will not just come from the beginning and say, this is the problem, this is the problem, this is the problem. Do you have specific questions that you have in mind that could at least help pull some of it out?
Well, I can tell you that I can look at a financial statement and I can tell you what a day in the life of that property manager is like just by looking at the financial statement. Now, as far as specific questions to ask them, some of the best times to ask questions is when you're doing your due diligence and you're doing your property inspection, you're going through each unit. Ask the tenants, so how's the management been? Do they fix things when you call them up? And then oh no, are you kidding? I've been trying to get that thing fixed for the last 4 weeks and I've been calling them all the time.
And they'll tell it to you straight. They'll tell you.
They got nothing to lose. And they walk in there and they say, you go back to the property, the manager's office and say, hey, let me see your work order list. And you go through the work order list, like this guy doesn't even have a work order in here. They're not even capturing all the jobs that need to be done in the property. And guess whose problem it's going to be in a month?
Exactly.
Yours. So that's those types of things you really want to get, and you can figure that out. That to be the case when the repairs and maintenance budget is not in line with your rules and thumb for that type of properties repair and maintenance budget. You can figure that out.
Got it. Love it. It's all, and getting back
to, talking about falling in love with a property. I was on a panel, I think it was one of Dan Hanford's events. I was on a panel with a bunch of other heavy hitters like myself. But they had a guy
incredibly good looking.
Well, the guy that I'm talking about, he was a good looking guy. I had to go head to head with that guy. But he was, he had like maybe 12,000 units. This guy was doing it right. And he was running it like a business. And he was nailing it. And he was treating multifamily like it is a commodity. And he bought properties. He never even went out to see them. His staff would go out there to see him just to make sure, but he would just, write the checks because you don't need, I've been
very objective numbers.
It's all about, because anything wrong, you just fix it, and I've been through 3,000 apartment units doing the due diligence. I hope I never have to go through another one because they all look the same to me. They all look the same. It takes me 8 minutes to go in and out of an apartment, and I get in, see what I want, and I get out. And they're all the same. They're just little factories of money. That's all you have to look at them as. So
I love that. Yeah, and if you're doing a, let's say, reposition, and let's say you're doing a two-tone paint scheme, it's an outdated. You're putting vinyl planks, stainless steel appliances that. All the units, unless it's completely down due to water damage or something along that nature, then it's going to be your typical just turn costs associated with that.
Yeah. And that's just, if you've done it a million times, you know exactly what it takes. You get your team in there, they bang it out, move on to the next one. And that's how you do it. It's just factory work. Don't think you got to set the stage and we're going to put in a little thing over there. No, it's just a factory. The people don't care. Give them a place to live over their heads, and they're happy with that.
Love it. Dropping true bombs. Those of you who are on here, of course, you want to go back, rewind, take notes. I'm taking notes as well. Also digging into some things. Definitely enjoy this. And so, Charles, you mentioned that very first deal is how did you structure that? Was an equity, or is that one that you structure like, well, now I actually should have structured it. This is my preferred route now.
Okay. Well, no. Okay. So here's, okay. Let me fast forward and kind of give you a primer on everything I've learned about how to finance or what have you. So that particular one we did with Fred's Bank. And if you were a student of mine, you'll know what I mean when I say Fred's Bank. That's a local bank, a local lender. That's a guy, you walk down the street and you're knocking on, hey, I'd like to buy this apartment building. Oh, sure, come on in.
And you already banked with them?
No,
Oh, you did? Okay.
They already had the note on the property, so they saw my balance sheet. They're like, my looks better than the other guy, and the other guy was going to lose the property, which is something I did not know at the time, and I wish I had. But they went. The next couple deals I did, GSEs, government-sponsored entities, Fannie and Freddie, okay?
Got it.
All right, so let's talk for a second about those two different scenarios and why they're so different and how they're different in how you run your business, okay? And this is, sometimes you're going to use a Fred's Bank, and sometimes you're going to use a Fannie and Freddie. But it's really, you've got to understand the difference between the two and why one's beneficial to the other at different times.
And also, those of you who are on here for the Freddie and the Fannies, another technical term is when people say agency debt. That's the same thing.
Exactly. Yep, exactly. So, see, even I learned things on your show, Sterling. Okay. So, Fred's Bank, I sit down with Fred. We hammer out the terms. Fred's interest rate's a little bit higher than the agency debt. Fred's loan to value is a little bit lower than the agency debt. He wants more skin in the game. And Fred does one thing that I really didn't like, and he made it a personal recourse loan. So that means if I screw up and I lose his property, not only do I lose the property, but any deficiency, he's going to come after my private residence. Okay? So in that regard, this was a tough paper to have. Okay. So it's more expensive. Fred's more conservative than the government because Fred's got his own little bank. He's not as big as he can't.
Less decision makers.
Exactly.
Yeah. You're dealing directly with
But then the other property I went to was I found a broker, and they took me to what I call DUS lenders, DUS, delegated underwriter and servicer lenders. These guys dole out the Fannie and the Freddie money, and so they're able to give me some pretty cool terms: lower interest rate than anybody else, 30-year amortization. Fred's doing a 20. They're going to do a maybe a 10-year term. Fred gave me a 7. And then they're going to do non-recourse loans. Okay.
And that M that you mentioned is huge. A 20-year and a 30, huge.
Yeah. And that has a huge impact on the cash on cash return for the deal. Exactly. And, so if you're looking to buy and hold, okay, Fred's Bank might be okay because that shorter amortization, you're just paying off the note faster. But if you're syndicating the deal, it's all about the velocity of money. And if you can capture more money faster and return it to your investors, their return goes up and you look like a hero. So why pay Fannie and Freddie their money back faster? You want to pay your investors faster. It's a beautiful ballet of numbers and money. It works beautifully. Okay, so I've got these two properties. One's with Fred's Bank, one's with Fannie Mae. The market crashes. Okay. Now my rents remain stable for the next 5 years, and I don't miss a payment. I don't miss a bill, but the value of my properties has gone down because the cap rates have gone up. Okay. Because the market has changed. Comes time for the end of the term of these notes. Okay. And I can't refinance them, and I can't sell them for what they're value, what they were valued at before, they've lost money. Remember that guru who said never went down in price? Yeah, well, he's an idiot.
So you mean, let's say an example, you buy it at a 6 cap or so or let's say you buy it at a 7 cap. In the future forecast, you would say, well, due to this asset, I forecasted to trade anywhere between a 5.5 to 6. But in your scenario, it went up to, let's say, an 8 or a 9.
Exactly, which means I lost $1 million of value, which means the banks are like, okay, time to cash in. And, I can't sell the property. I can't sell the property because I'm going to lose. I can't even release the note. So I sit down with Fred. And I said, Fred, I got a problem. I need more time. I need you to do this. And he goes, all right, well, this is how we're going to do it. And we're going to structure it this way. And then this we're going to have a note A and a note B. And all the time we're doing this, there is a little plate of French fries in front of us with ketchup in the diner. Okay. And I'm sitting there with Fred and we're figuring out how to solve this problem. And we shake hands and we walk out of there and we solve the problem. Mm-hmm. I go down to have the same meeting with the government sponsored entities, the Fannie and Freddies, the people who don't really give a rat's ass about you. And I said, guys, I got a problem. And they said, yeah, okay. We're going to take your property back. I'm like, no, listen. I've been killing myself for the last 7 years over this deal. Why, give me more time. No, we don't give you more time. We're not like that. We're not a bank. This is not really a mortgage, even though you think it's a mortgage. This is what's called a commercial mortgage-backed security. And
got it.
The people who have these securities, they want their money. So we're just going to take your property back. I'm like, well, wait, we can't rewrite this. There's nothing to rewrite. There's no mortgage. There's nothing. Whatever you did with Fred over the French fries, you can't do with us. We're not Fred. And so that's something you as a business owner, as you're building your business, these are the types of things you really need to think about long-term, because you're not going to make $1 million overnight in multifamily, but you are going to make multi-millions over time. And so during that process of time, you've got to figure out how exactly to build that business the right way.
Gosh, I love how you just went into those various scenarios and really just broke them down, because it's how you had that open communication with the smaller bank, Fred's bank. But in addition to that, and this is one thing I want your take is, those agencies don't look so much at the little guys, but however, if you have billions of dollars in terms of debt from them, do you believe that would be a different conversation?
Oh, absolutely. Remember that famous saying, if you owe the bank $100,000, the bank owns you. If you owe the bank $100 million, you own the bank. And that is so true. Let me tell you something. That is how it works. That's what it's all about. And yeah, absolutely. So, So.
And so how are you finding investors on your deals now? How does that work from that standpoint?
Yeah, so I went that full route with the big syndication. We had 35 people in one deal and all this type of stuff. And I'll tell you, over time, I've got one partner in one of my deals, so just the two of us. And we're about to do another deal, and we're going to bring a third guy in. And in this regard, we may not even have to do a syndication or call it, with securities. Mm-hmm. We may just do a joint venture where all three of us have roles and responsibilities that are equal, and we work together. It's really a different world. And I know that, you're out there, you see the syndication world, you see people talking about it. It's fraught with problems. I got sued by the SEC, and it was the most unbelievable experience I've ever been through. I don't wish this on my worst enemy. Wiped me out financially. I didn't even do anything wrong, and they didn't even care. They just didn't. Wow. And so I teach my students, I say, you guys got to do it this way. If you're going to do it, you got to do it this way. Don't cut corners. Don't try to play fast and loose. I see these other guys out there using capital raisers, and this scares the daylights out of me. As a matter of fact,
you mean like an equity partner that, let's say, total raise is $2 million. You'll go find a group that brings $1 million is that what you mean?
Yeah, and then you earn a fee off of that money that you bring in. Totally illegal. I see it happening all the time. The SEC is already onto these people, and it's just a matter of time. And, as a matter of fact, it happened, you saw it in the newspaper, Richard Shapiro running a Ponzi scheme, but now all his capital raisers are now getting into trouble because he did the same thing. Unregistered reps is what these people are. And the SEC does not like that at all. So, so you got to be careful. Just do it right, or don't do it at all, because if you do it wrong, in my particular case, I didn't even see it coming. It was a partner in one of my deals that was a cowboy, and we didn't even know it. We didn't even. Next thing we know, there's a knock on the door, sheriff's serving us with papers.
And
terrible.
I want to dig into that, but
Go ahead, write it down. Write it down.
Do you believe that there were signs that dictated that person being a cowboy to avoid that from the start?
Oh gosh, what a tough question. Oh my gosh. Oh, if you knew the story. Oh, okay.
So yes. No way.
Okay. Everything I'm about to say is absolutely true. And I think this is going to be the best way that I can answer your fantastic question. Okay. I worked closely with this guy for 3 to 5 years. Almost every day working on deals. We owned a ton of property together. He was married with 2 boys. One of them is now a pilot with the Navy. The other one, I don't know what he's doing. When we had this blow up with the SEC, and it just destroyed our business, it destroyed our relationship. I remember the last time I had ever spoken to him, it was a screaming match, and he hung up the phone, and I never heard from him again.
Wow.
Fast forward 10 years. I get a letter from a lawyer on a property that we used to own looking for us. And I'm out there. Everybody knows who I am. You can track me down, no problem. But he was having trouble finding 2 of my partners. And in this letter that he said, Robert Smith, now known as Roberta Smith.
Oh, got it. Yeah.
And I saw that. I thought, what? I called my wife. I said, Bob is now Roberta. And she jumps on Facebook and she finds her.
Oh, gotcha. Oh.
Yeah. And Sterling, I'm talking about, he's no longer a him.
Got it. Okay.
The full Monty gone because she was modeling bikinis. And okay. Now the answer to your question, this is not a judgment call on him or his lifestyle, whatever. It has to do with the fact that I worked with this guy every day for 4 to 5 years, and I never saw any of this coming. So to answer your question about what could I have seen of the man, I can't answer your question. I got, I don't want to say snookered or bamboozled. That wasn't the case at all, but I never saw the true type of person that this person was.
Wow. Gotcha.
So, man, I mean, you asked a tough question, and unfortunately, I had a real answer for you, Sterling.
Yeah.
Yeah, I can't.
So there was just nothing that you could have been able to, because that person, whether or not they consciously did it, was. I get what you.
They did something wrong with a website that I didn't even know we had the website, and it was a little tiny thing, but the SEC blew it totally out of proportion. But I'm telling you,
understood.
I'm sorry. I'm sorry, Your Honor. That's the best answer I can come up with at this time.
Understood. Awesome. Okay, perfect. Well, let's go ahead and shift to our rapid fire sharing round.
You are sorry you asked that question. Yeah. You can't wait to change this subject fast enough.
But what is one common myth that you hear in the industry that you can debunk?
Go big or go home.
Okay, understood.
That may work for some people. It doesn't work for everybody. Build it the right way. Build it the way that's right for you.
Got it. And
Nailed that one. Give me another one. Go
yes.
ahead.
Okay. The next one is, what is one absurd or unusual habit that you love to do
Oh my God.
or activity?
Oh, everybody, I love flying my plane. I've got the most beautiful little plane, and it's my little baby. It's my hobby, and I love going flying. And so that's the thing that I love to do.
Awesome. And the last question is, why do you believe we're here on Earth?
Oh, we got to do it to help other people. And we're all perfecting this thing, whatever this thing is. And we're all trying to get to a better place. And man, it's just, if you can't do it by helping other people. And that's the thing, people ask me, why are you, here's a perfect example. When I got out of college, I went to work for New York Life. My father had been a New York Life agent for 57 years. My manager was a guy by the name of Tim Miller, still a friend of mine to this day. And he was a very successful agent, came out of the field, became a manager. And I remember one time sitting in his office, I was probably 22, 23 years old, didn't even know what I was going to do that weekend, for a job or for the weekend. I sit down with him and I said, Tim, you are a successful agent. Why would you ever want to go into management? And he said something that stuck with me. He said, because I really like seeing you succeed and I want to help you succeed. And I thought to myself, Sterling, that is the stupidest thing I have ever heard in my entire life. Now, 30 years later, because I am a slow learner, 30 years later, I got a client that just got a deal under contract, his first deal under contract, and we had to do it over the 4th of July. I didn't care what day it was. I was helping that student make sure he did it right, because I want to help people succeed. And, we can do so many cool things with our success, and that's what I want to do. So,
yeah. And Tony Robbins has that quote, is the secret to living is giving.
Yeah.
So, yeah.
Absolutely.
True. Yeah. So, Charles, how can people find you?
Oh, check me out on multifamilyinvestingacademy.com or themultifamilyattorney.com. It all goes to the same place. You can sign up for my vlogs, my podcast, my stuff. I mean, I'm an open book. Come out there and check me out. And it's I absolutely love it. And I'm coming out in the end of August. I'm partnering with another attorney, and we're creating a program that is just kick-ass, and it's going to be like none other. And I can't wait for it. It's going to be good. So stay tuned. So get on my mailing list so I can track you down when the time comes.
Awesome. Thanks so much for being on the podcast, Charles, and dropping those bombs, golden nuggets. So many lessons learned from that. I've got my notes, and I truly did enjoy that. So thanks for being on the podcast, Charles.
All right, now hold on. I gotta just share one new thing, because I listen to podcasts all the time, and sometimes most of the time it's usually a true crime murder mystery podcast. But anyway, all right. I got this one by Sean Croxton. Do you know Sean Croxton?
No, I do not.
Okay, the quote of the day show, daily motivational talks. Really good stuff. And so I recommend you do that, because I got this one today. Brian Tracy said, poor people have poor ways and rich people have rich ways. And that's when you think about it, that's so true. So true. And I remember when I was poor, and I remember when I was rich, and we definitely, you've got to change your mindset. You got to think differently.
That's where it starts. All right. Thanks so much, Charles. Dropping bombs.
Thanks, Sterling. I'll talk to you later.
All right.
Bye-bye.
Thanks for listening to The Real Estate Experience. If this has brought you any value, please subscribe and leave a 5-star rating. It would mean the world to me. Now go out there and crush it.